Hello everybody, welcome to another update on the stock forecaster. Um, I'm not going over my portfolio today because we're still in Step of Gold, still waiting on that. And I just wanted to talk about a new company, a new gold company that I find very interesting and it is very undervalued. So this is Winston Gold Corp. It has a market cap of 30 million. You can see that this has gone up, but I think that it's not done yet. And I'll show you why. So this is a gold company in the United States, in Montana. Uh, Most importantly, this guy here is a major shareholder, and this is a director from Newmont Mining, and he quit his job and he went to this company. So that means a lot already. Um, The management team is very good. They have the best of the best people from all over the world coming here. They have a very good metallurgists, very good engineers. So we have a very good team here. And what does this company do? They are going into production by the end of this month. So that's also important. We are going into a cash flowing company here. And that's when you buy gold companies. That's the perfect time to buy this. And let's see what they have. They have one mine here, the Winston property, the Winston mine. Um, they don't have any uh, resources yet defined here. They only have some drill holes, but I think that will come later on in a few years. The most important here is that they know where the resources are. And these resources are very high grade, as you can see here, 60 gram per ton, very high grade. But these are narrow veins. It's good to know. You can see it's very consistent here. Now, so how does this look like? They have three veins here, the parallel vein, block vein, cluster vein, and they're going to start mining these two veins. And this is very important here. You have the following amount of productions. By next year, they will have 250 tons per day, and that will keep growing and growing. And in 3 years, we have also the cluster vein added, and then we will probably have something like 750 tons per day. So there's a lot of growth here. That's good to know. And it's also very easy to upgrade the mill. The mill is already here. Everything is financed. They have everything ready. And the mill has a capacity of 170 tons per day and is easily upgradable. So everything is in place here. You can see here 200 tons per day is the capacity. You can see also that there are a lot of, well, not a lot, but just a few amount of costs. G&A is only 200,000. The cash cost is only 850. Development costs is already financed and it's scalable. So they don't have any resources defined yet, but that will come. This is the only risk factor here. They still have a lot of warrants, and those warrants are in the range of 0.1, 0.2. We are in that range right now. So it could be that the market cap can go higher from the 30 million we have now. So probably it can go to 50 million, but that's all if they exercise those warrants. But I will show you that there is still a lot of upside potential here. So I've prepared this Excel sheet here. So this 30 million market cap could go to 50 million if they exercise the warrants. So let's take the tons per day. We have 170 tons per day. And from their news releases, we know that they had 7 grams per ton of gold when they were developing the tunnels. But when they reach the ore, then this will go higher. 7 will go to 9, maybe even 10 grams per ton of gold. So if we multiply it with the amount of tons per day, then we get 1,500 grams of gold per day. And that's in ounces, that's 50 ounces per day. And per year, that will amount to 16,000 ounces per year. And I've also calculated this with the gold recovery of 94%. So this is the amount of gold production they will have per year if we start with the current mill. Okay, this is the capex, 1.5 million. It's already financed, and the AISC is around 800, 900, and I've taken 1,000 just for safety purposes. It's probably lower than that. And let's take an EBITDA multiple of 5, which is very conservative. Okay, so we are going to calculate this. We have gold price, share price, market cap is 33. And the estimated value is the amount of production times the gold price minus the AISC times the multiple of 5. So we get 77 million as a first number here. So currently we have 30 million. It could go to 50 million with the warrants exercise. So we still have a lot of upside from 50 million to 80 million. That's at least 60-70% higher upside. Okay. But let's say the grade is actually 10. That's very possible. And let's say the AIC is 900. Then we have 100 almost. So that's a double from 50 to 100. And let's say we are already next year in June 2021, and they have upgraded their mill to 250 tons per day. So what will happen then? Then we will go from 50 million to 150 million. That's a threefold. A threefold. And let's also say that the gold price is not 1915 today, but next year the gold price is like 2,300, which is very possible. Then we get 200 million of estimated value. So we are going from 50 to 200. That's a fourfold for next year. And it's not done yet. It's not done yet because let's say we are in 2022, 2 years after we initially invested here. Typically, an investor would hold a company for 2 years. And we are at 375 tons per day. So that would bring our estimated fell to 300, from 50 to 300. That's a six-fold in 2 years. And let's say that that people are going to speculate on gold miners, and the EBITDA multiple goes from 5 to 8, for example, because there's a mania in gold. Then we are going from 50 to almost 500 million. So that would be a tenfold for this company. And this is perfectly possible. And we're not even talking about 2023, where we have all the three veins in production. And that would mean that we have 750 tons per day. So we are talking about a $1 billion company in 3 years. From 50 million, we go to 1 billion. That's a 20-fold. So this is completely undervalued, and we're going to buy a boatload of shares of this company. And we have a 3-year horizon on this. Hope you liked this video, and I'll see you in the next video.